Now, the global economy is facing its worst recession since the 1930s. That is according to the International Monetary Fund, which has sharply cut its 2020 forecast because of the coronavirus pandemic and the lockdowns. Well, the IMF predicts a 3% contraction for the global economy this year, describing the Great Lockdown as a crisis like no other. Well, France 24's business editor Kate Moody joins me now. Kate, tell us more about these rather grim forecasts.
Yeah, a grim outlook, but very few surprises, Tom. This outlook underscoring the magnitude of the current crisis, the damage being faced. It's far deeper and more wide-ranging, even than we saw in the financial crisis of a decade ago. Now, in January, the International Monetary Fund was projecting the global economy would grow 3.3% in 2020. It now believes that the global economy will contract by about as much. Advanced economies are likely to see more damage than emerging economies, and that's because China is still officially classed in that developing economy category. The Eurozone is set to be among the most affected, with GDP growth expected to contract around 7.5%. The U.S. economy expected to contract around 6%. China's economy forecast to buck the trend, in part because its growth rate is already so strong and the government is already so implicated in the economy. 1.2% would still be its slowest rate of growth since the 1970s. Now, all these numbers are based on the so-called baseline scenario, which would see the virus contained in the coming months and global economic activity able to start up again in the second half of the year. The IMF noting, though, that there is so much uncertainty around this pandemic that it could be much, much worse. Depending on how long the pandemic goes on, the damage could be as much as doubled if the virus were not to be brought under control, if the virus were to come back for a second round. Now, if it's contained, the IMF predicts that 2021 will see a rebound of about 5.8% GDP growth. That is, though, far, far from certain. And it's worth pointing out that as gloomy as this seems, the IMF is actually a bit more optimistic than some of the other forecasts we've seen. Calculations by the UK's Office for Budget Responsibility, for example, see the British economy shrinking 13% this year. The IMF predicts about half of that. Again, even in the best case scenario, the IMF believes the world will be losing out on about $9 trillion worth of output over 2 years.
Okay, Kate, what's the feeling as to just what governments need to be doing in order to limit the damage and really set the stage for recovery?
Well, the IMF has underscored that containment is key. It believes that these social distancing measures and lockdowns are really going to be important to containing the virus. And that's the only way, of course, that economic growth can start up again. The IMF forecasts rely on swift and sizable financial support from governments around the world as well. That would include significant financial support for healthcare systems, money for people and families who are the most affected. And in particular, it pointed out the families of healthcare workers or people working on the front line should get extra support. Also, short-term loans for businesses and a more flexible approach to debt repayments. And that holds true for countries as well as on an individual level. Just this Monday, the IMF announced it would be forgiving over $200 million worth of debt for the world's 25 poorest countries. To that end, finance ministers and central bank governors from the G7 group have just this Tuesday backed temporary debt relief for many economies, but that's only if the larger G20 group, which includes China, gets on board. The idea is to allow and encourage governments to devote all the financial resources they can to fighting and containing this virus rather than worrying about those looming debt payments. The IMF is stressing that this economic crisis isn't just about big numbers. It's really about lives and livelihoods.
Okay, Kate Moody, our business editor, thank you very much indeed for that.